Hello, welcome to our new video. Myself Ankita, faculty at Commerce Department, Hansraj College, University of Delhi. This video is in continuation of our course on financial markets. In this particular video, we will understand about the primary markets, that what do we understand by the financial markets, what are the different players in it, and what is the role played by the primary markets in the entire financial markets. Okay, so let's start with our video. First of all is the basic introduction of the primary markets. So primary markets involves issuance of securities for the first time. Whenever companies wishes to raise capital, they do it in different ways. Like they raises the funds directly from the public. Whenever company raises the fund directly from the public, it happens through a process called initial public offering, or we call it as IPO. So IPO, initial public offering. This is the process through which companies raises funds from the investors for the first time. And this process is done via primary markets. So primary markets helps companies to raise funds for the first time. Now the question arises that do the companies themselves do this process of raising funds? Do companies themselves ask investors to subscribe to their IPO, or do they hire some other firm for doing such activities? So usually companies hire professionals, experts who have knowledge of this industry, who have knowledge that at what time company should release IPO. They understand the market sentiments as well as the timings. So such entities which help companies in raising funds for the first time are known as investment bankers. All right. So who helps in issuance of securities? It is the investment bankers. Investment bankers help companies in raising funds from the public. So these are the participants in the marketplace that work with issuers to distribute newly issued securities. This activity is undertaken by the security houses and the commercial banks. Who are the security houses? Security houses are the stock exchanges. Like we have two major stock exchanges, National Stock Exchange and the Bombay Stock Exchange. Then there are other regional stock exchanges also. So they help companies in deciding that at what time they should bring out IPO and help companies in raising funds. Also, then there are commercial banks. Commercial banks also have their department by the name investment banking or any other name like corporate banking. In this, they have hired investment managers, consultant, experts who play a major role in bringing IPO of different corporates in the markets. So they have huge expertise and huge knowledge in this area, and they help companies in raising funds. Okay. Now, what is the role played by the investment bankers? Investment bankers firstly advises the companies that in which securities, what type of security should they raise, what is the timing, what is the perfect timing of bringing out IPOs, to which sector of investment should be targeted, and what should be the price at which they should issue the securities. So there are various different factors involved in this process, which is only usually understood by the investment banker. So they help companies in advising them that at what time should they issue securities. Also, whenever company brings out the IPO, they have to register a form with the Securities Exchange Board of India and bring out the prospectus and do lot of formalities and documentation, which is usually done by the investment bankers themselves. So they help firms in advising, and then they also buy the securities. They usually buy out the securities which are issued by the companies, and then it distributes to the investors. So these are the three major roles which are played by the investment bankers, that they advises the companies, then they buy the issue the whole issue, or the unsold issue, that if some securities are left which they are not able to sell to the public, then they themselves will buy it, then they distribute it to the public through advertisement, through hiring stockbrokers, distributors. They have a whole gamut, the whole network of stockbrokers, distributors, different selling agents who help selling that IPO to the general public. Moving further, in extension to the investment bankers, we have underwriters. What do we understand by the underwriters? So, whenever an investment banker buys securities from the issuer and accept the risk of selling the securities to the investor at the lower price. So, underwriters buy securities from the issuer and accept the risk. Investment in underwriters bear the risk of non-selling of the securities. They assures the firm that they will buy the unsold securities. Okay. So there is a difference in the price at which underwriters buy securities from the firm and sell it out further to the investor. They buy at lower prices and sell it out at higher prices. This difference in the prices is known as underwriter discount or gross spread. Okay. Bid minus ask, which means buy price minus sell price. They buy at low prices and sell it out at higher prices, which is known as underwriter discount or gross spread. There are two mechanisms through which this process is accomplished. First one is the firm commitment and another one is the best efforts. Firm commitment means that underwriters give assurance and guarantee to the firm that they will buy the unsold securities. So now the risk of unsold securities entirely transferred to the underwriters. Firm is entirely or a company is entirely relieved. They already know that at what price their shares will be issued in the market and they are relaxed that what is the amount of total capital which they are going to raise from the markets. But in case of the best efforts, underwriters give a general agreement to the firm that they will try their best to sell these securities in the secondary market. They will try their best to sell these securities in the market. But if they are unable to do that, the risk of unsold securities will be borne by the firm only. Okay, so there are two ways here, firm commitment and the best efforts. So there is a process through which securities are issued in the primary market. There are factors involved. The first factor is the prospectus. This is the most important one. Prospectus. That company needs to bring out the prospectus before bringing out IPO. Prospectus refers to the invitation given to the public to subscribe to the shares of the company. In the prospectus, all the materialistic information which are necessary for the investor to take decisions whether they should invest in company share or not is given. Company's profitability last 10 years or 5 years, balance sheet, profit and loss statement, all the materialistic informations are mentioned in the prospectus as well as their future prospects, that how these funds will be utilized in the future. Okay, so whenever a company brings out the IPO, there is always a price at which they bring out, right? There will be a share price at which they will bring out the shares. That is not in a single value. That is always in a band which is known as the offer price. So companies usually bring out the offer price. It is a band, it is a range in which investors can bid their prices, that at what price they wishes to buy the shares. So the difference, there are two prices. One is the lower price, other is the higher price. Floor price refers to the lower price of the band. Lower price of the band. Like, let's say that a company brings out an IPO in the price range of, let's suppose, 150 to 180 rupees. So 150 will be known as the floor price. This is the lowest price of the offer price. Then there is a cap price, which is the highest price of the band, which is 180. So investors can choose any price between 150 to 180 when he will bid for the shares. Okay, so this is the lowest, floor price and the cap price. Now you can see here that offer price of the company's share, price band, which is this is the offer price of the company's share. The spread between the floor price and the cap price shall not be more than 20%. So this is as per the SEBI regulation, that if our floor price is 100 rupees, then cap price can be decided at max at 120 rupees. 120% of 100 is 120 rupees, right? So this is about the price band. Then what do we mean by the face value? Face value is the nominal value or the minimal value of the share. This is the minimum value of the share, which is usually decided by the company. It is at rupees 1, 2, 3 or rupees 10 at max. Then the issue price is always at a premium. That if company, a face value of the share is rupees 10, but company is bringing out the share at rupees 150. Okay, so 140 rupees is the premium. They are selling these shares at a premium. There are few examples which are mentioned here related to the IPO. For example, that last year in October, Nykaa bring out their first IPO and the price band of 1085 to 1125. This was the price band in which they bring out their IPO. Then also LIC. LIC bring out their IPO in the price band of 2000 rupees to 2100 rupees. Okay, so these are the examples of the IPO which came last year. Next is the regulation of the primary market. It is very important to regulate the primary market, because in this market, the interest of the common man, the interest of the small investors are involved. Small investors put their savings in the IPO to invest in the funds. So it is very important that this process of IPO happens very legally, happens in a legal manner and in a fair manner. Okay, so SEBI, which is the Securities Exchange Board of India, regulates the primary market in our country, India. And it is important that underwriters issue our due diligence certificates. In the due diligence certificates, it is mentioned that underwriters have taken reasonable steps to ensure that all the materialistic information is included in the prospectus and the whole process of IPO is done in a fair and rightly manner. There are no fraudulent activities involved in it. Disclosure of all material fact. It is important. Underwriters have to ensure that all the material facts have been included in the prospectus and whole issue process is done in a fair manner. Okay, so due diligence certificate is usually issued by the underwriters, and only then SEBI will give green sign that now they can go for an IPO. Till now, we have studied that company raises fund by inviting public to apply for the shares. But there are other ways also that company can raise new funds in the market. One such process is known as preemptive right offering, which is also known as the right issue of shares. In this process, already existing shareholders give rights to apply for the new shares of the company at a lower price, at a price lower than the market price. So the already existing shareholders can buy new shares of the company directly from the company at a price lower than the market value. So this is the right given to the existing shareholders. Okay, so the price is known as the subscription price. For example, that in a market, price of a share price of any company is at 1000 rupees. Share price. But whenever company decided to bring out new shares through the preemptive right offering, they give existing shareholders right that they can buy new issue of a company at rupees 700 at discounted price. So existing shareholders can buy this share at rupees 700 and later on can sell it in the market at rupees 1000, which was existing at that time. So it will give advantage to the existing shareholder. Also, it helps existing shareholders to keep their ownership with themselves. Whenever company raises funds from the public, it diluted the ownership of the existing shareholders, right? Their ownership percentage will decrease. But when new shares are issued, they are still with the existing shareholders. Their existing voting powers, their proportion in the total capital will remain intact. Right? Then, how it happens? Each existing shareholder would receive one right for every 3 shares held. So, what happens is that whenever a company goes for the right issue, it gives shares in proportion. Like it could give one shareholder one share, or maybe in another ratios or proportion. Like here is an example that each existing shareholders would receive one right for every 3 owned, which means if any shareholders is holding 3 shares already, he will get one more share. Like if a shareholder who is owning 300 shares, he will get how much? 100 more shares. Or if a shareholder is holding, let's suppose 200 shares, then how much more shares he will receive? He will get 100 more shares. Next way through which company can raise capital in the primary market is through the private placement of shares. As the name suggests, that shares are privately placed with some already identified individuals. Okay, so here private placement is a sale of securities to pre-selected individuals and institutions. That company have already decided and identified the individuals to whom shares will be issued. Shares will be asked for. There is a minimal regulatory requirement from such for such issuance of shares. As in case of private placement of shares, the private players which are involved, which who buys the securities, are usually institutional investors like banks, mutual funds, wealthy individual investors, or the insurance companies. So the huge financial institutions who have large amount of funds, they invest in company securities through in the private placement of shares. So they themselves have huge knowledge and expertise to decide the price, or they should invest in this or not. So minimum regulatory requirements are least in such cases because they themselves have knowledge to decide. But in case of initial public offering, since the general public involves, public interest is involved, that's why SEBI has to play a key role in regulating the primary market or the IPO market. Okay, so in this particular video, we have learned the whole basics of the primary markets, the ways through which company can raise funds through the IPO or through the preemptive right offering, or we can call it as the right issue of shares, and the private placement of shares. I hope you get a good understanding of the primary markets. I will meet you again in the next video in which we will discuss about the secondary markets. Thank you so much.